All right, so I'm Ron Sweet. This is my favorite class. I love risk management. This is um this is my career is risk management. It'd be your career too. Everybody's a risk manager. That's what finance is. They should rename finance the risk management. Actuary as well. It's risk management. Marketing as well, accounting as well. It's all risk management. That's what we do. That's what we get paid for doing. So I've got Canvas up, so I'll walk through. I have the student view, so hopefully this works. So you've got the syllabus, and we'll walk through the syllabus, and you have the class notes. We'll definitely be using the class notes as our textbook. No textbook. There is no good textbook for risk management. Some of the worst textbooks ever written are risk management textbooks. So there's the, and they're really, really boring textbooks. So we're going to use the group of 30s framework for risk. It's going to be much more finance focused and actuarial science focused than it's going to be insurance focused as far as insurance contracts, because I teach insurance classes, so we don't need to do insurance in this class. The finance part of risk management is far more interesting anyway. So we'll walk through that. And then I have the modules. One of the complaints I got in the survey last semester was, I wish you'd have your Canvas in modules. I'm still learning Canvas. It's a little bizarre to me, some of the things it does, but we'll do an overview, which is the first 10 pages of the class notes. And then we'll get into my favorite topic, which is interest rate risk management. Some of you are taking John Toohey's class. I was eavesdropping on his class today. So obviously there's a lot of interest rate risk when you talk about bonds. We're going to focus mainly on banks and insurance companies and pension plans. And so we're going to be looking at some special cases. You can see there's a lot of files under interest rate risk, and then we'll go into liquidity risk. And then we'll spend quite a bit of time on market risk, which is the other really, really large risk. So you can see we're going risk by risk, credit risk, and then we got a bunch of other risk after that that we'll go into. And then I want to get a little philosophical with some of the brightest writers in risk management. I haven't added any to this list because this list is still my favorite. I keep reading books, trying to find new angles on risk. But we're going to talk my favorite writers. Kahneman's the obvious one, but we're also going to do Taleb. Y'all probably all heard Taleb, Nissim Taleb. Annie Duke. Any of y'all know Annie Duke? I push her book quite a bit. So we'll see what she has to say. And then one of my favorite of all is Doug Hubbard, which I strongly recommend you read all of his books. So we'll get into those. And then as we have time to do some case studies, I always like to have a real life case study. So I'm looking for one. Last semester, I invited United Airlines to come. I wanted to talk about what COVID did to United Airlines. It's not very common that a large corporation sees their revenue drop 80% in 1 year. That's a pretty unusual year. So we were asking him, how did you handle that? And my question to him was, how did you handle coming back out? Because they had to shut all this stuff down, get rid of all these people, then they had to bring it. So it's a really interesting conversation. 2 years ago, was it 2021? 2021, I had a friend who was an expert on ERCOT, what is it? The Texas utility people with the, y'all probably don't remember the big energy crisis in 2021. I lost my energy for 5 days. And I ride my bike every day. So I'm riding my bike in 18-degree weather, and then I come home to no electricity. So I'm just about to die of hypothermia or whatever. So that was really interesting how horribly run that organization was when it comes to risk that was so obvious. And it was interesting to hearing him say that they had a board meeting right before the winter storm, and no one even brought up the winter storm. This major, major event that was probably going to wipe out all this electricity, and that wasn't an issue for them. They didn't care. So interesting. So I'm trying to find one for this semester. If you have an idea, let me know. I was trying to get the FAA, but their website's not real friendly. But the airlines industry is really good risk managers. I'd love to get one of them in to talk about airline safety and crash, those kind of things. But I'll try to find something. If something happens between now and that, we'll invite them to come in and talk. I was going to say, unless you're Boeing. Yeah, Boeing. I don't have any contacts at Boeing, so I don't know. I have to see. I'll think about it. I have one former student who works in New York, and he's doing risk management for the city of New York. He has an incredible website. It's really quite interesting. One of the risks he does is earthquake risk. And he starts off, obviously you don't think of earthquake risk in New York, but it's an interesting, he's done a really good job. It's a very interesting webpage. So it can be kind of interesting. Obviously, wind is a huge issue for New York after Sandy. That was a lot of risk. So we'll try to find something. I'm not saying I hope something major happens. I saw an article that Kim might be declaring war here pretty soon. We never know if President Xi might attack Taiwan. Those are risks that have untold. Who knows what an attack on Taiwan would do to the semiconductor market and everything else. I mean, it'd just be the human toll would be amazing. So I'm not hoping we get a good case that comes up. But I've got some cases I like to use. They're pretty old because they teach very specific things that work really well as a case study. 2008 is a case study, but there's too many actors and too many things going on. COVID's a case study, but it's a little too, we're still trying to figure out whom to blame. So that's the layout. We'll spend a lot of time on the interest rate risk. So let's get into the, well, my background is I was at UTSA for years, started on the corporate, well, I started in accounting, moved to the corporate side, did a lot in a department called capital management. You think about capital management for insurance companies, capital is their net worth. They don't call it net worth management, they call it capital management. And so, why do you think, y'all can probably guess this, what's the single largest risk at UTSA? What's the thing that could wipe them out more than any other risk? Yeah, it's catastrophes, earthquakes, hurricanes. So that was their biggest risk. My goal was to take all these risks and look at them, see if they're offsetting. We'll talk some about that. It's really interesting stuff of how they're different entities offset each other, especially life insurance versus banking is really, really interesting. But every study we did, every analysis we did, we're worried about what happens if we have a bubonic plague, what happens to our life insurance company, what happens in a recession, you have all these auto loans sold off at the bank. It didn't matter. Those were $100 and $200 million risk. And the property and casualty side was $3 and $4 billion risk. It's like, why are we wasting, let's manage that one risk. So a lot of background on that side. And then I moved from there into the investment side and managing interest rate risk, managing stock risk. Those are the main risks. I'd worked some with real estate. I'm not a real estate person, but worked some with real estate. So good kind of diverse background. So if we look at the syllabus, just what we have to do, people complain that my classes don't have enough stuff graded. It's just my preference. I think you should go really deep into certain topics and not learn a million topics in a shallow way. And we're going to hit some really, I think, critical topics. I've even had people at Goldman say, make sure you take this class because I'm talking very much the way Goldman thinks, and it really helps them in the interviews. So we'll have 2 exams. You'll know exactly what's on the exam before the exam, and you'll have plenty of practice problems. So there's going to be some killer essays on these exams, which you'll know in advance, and we'll talk about them. The first paper is the toughest thing in the class, and you'll probably want to start on that like 30 minutes ago. You need to get into it. And that's really your focus right now is to get this first paper done. It's a tough paper, but it's one paper that has helped a lot of students get jobs. I know one lady interviewed in a job in Houston. She took the paper from this class and showed it to them. They said, was that a group project? She says, no, I wrote this. And she got to the next level just by showing the paper. It was a really powerful paper. So I've thought about changing to something else, but I've gotten so much mileage out of this paper for students and interviews and other things because it's a really helpful paper. So I'll talk about some of that tonight so you can start working on it. The risk project's pretty straightforward. It's a portfolio project. I do have an option where you can get some 10% bonus. You go and use the portfolio function on the Bloomberg machine. And so I'll give you that option. No one's taken it yet because it's kind of time consuming. So it's one of those things, a lot of work for just 10% extra credit. If you want to, are there any more desks? There's some back in the back there. So sorry. Yeah, y'all don't even have anything to write on, do you? Wow. But it's a really valuable project because it does what computer systems do. So you're talking about efficient frontiers and managing attribution and value risk kind of stuff, I'm making you build it in an Excel spreadsheet. I've already got the spreadsheet built, but you see it built. But it gives you a huge advantage when you use the typical software packages that you'll see out there, whether it's Lipper or Morningstar or whatever. I think it's a huge advantage if you do it by hand and see how it's actually being calculated so you understand what's going on behind the scenes. But it's a fairly straightforward project. So the second project's much easier than the first one. I do require attendance. I heard John say he doesn't require attendance. I do, just because I don't want to teach empty classrooms. And I've kind of learned the secret to taking attendance is that unengaged students avoid my class, which is exactly what I want. So to me, it's the trick. I have a better high quality classroom. I just like it better. But 10 years from now, I'll probably be the only person on campus. We'll have these massive buildings and I'll be the only one in the classroom talking to anybody, because it's just everything's going online, isn't it? More and more of your classes, you all even have classes where you don't have a choice to be in person. So the world is changing. So attendance can help your grade. It can hurt your grade. Make sure you read the attendance in the syllabus. You have to be in class for it to count. You can do 3 absence makes-ups by watching the YouTube or going in on Zoom and sending me your notes. The day doesn't count. Thursday doesn't count, so we'll start next week. So you can make up absences, but you only get 3. I usually have some student, like in mid-April, Professor, I haven't been here all semester because I have a problem. It's making sure that's okay. It's like, no, the syllabus is really, really clear. So I'll be reminding you, students that aren't here, that you need to be here, which means we need a seating chart so I can learn all of your names. We'll have to figure out how to do a seating chart in a room that is not very well organized. We'll figure that out. So Thursday, try to get here and get the seat you want. We need to move those seats back. Boy, maybe we can move this table over. We'll have to figure it out. It's going to be a mess because anything we do is going to be undone by another class. And then the instructor survey, if you do that, you get 10 points. I always love it to have students that are on the edge of passing, and they're most likely ones not to do the survey. I don't understand that. The ones who most desperately, the students with a 99.9 average, they're the ones that do the surveys. So I mean, it's like 1% on your grade for free, but just do it. All this other stuff, I don't know why they make us put all this other stuff in there. You have a little bit of a discussion on the papers. We'll talk about them. So we'll start off with some backgrounds, some level setting. I'm going to use a little bit of Peter Bernstein to set up the history of risk management. And then my favorite topic, interest rate risk. So why do I like interest rate risk so much? It's a risk, especially at USAA. This is my thing at USAA. You walk in, you see a risk that's not well managed, and it's interest rate risk. You can fix it and go home, and you fix it. You can't say that with equities or real estate because there's so many other things going on. But with interest rate risk, it's one risk we can actually fix. The banking industry is really good at it. The life insurance industry is the best at it. There's no entity that does it better. But not all banks are good at it. So what bank blew up because of bad interest rate risk management? Yeah, Silicon Valley. That was an interest rate risk, and a pretty simple one. We're going to do projects. We're going to do exercises in this class where if you'd worked for Silicon Valley, you could have saved them all of that mess. You would have said, what are you guys doing? Don't you see you're unbalanced here? It would have been pretty obvious. And they should have seen it. That was a pretty obvious one to fix. So I like in finance where we actually had tools to actually fix things. And you can go home and say, hey, I fixed that. Like a plumber, right? Your plumber is not like your wealth manager. He doesn't come in, well, you got a 60% chance that it works. You got a 40% chance you're going to have to, that's wealth management. But plumbers come in, they fix it, they go home, it's fixed. That's what interest rate risk is. You can actually do something that's quite valuable. We'll spend a little bit of time on liquidity risk. And then obviously, market risk is a huge one. We'll talk quite a bit about value at risk and using options and those kind of things to try to manage those risks. That's where I ended my career. I was head of equity when I finished. We did use options on our stock portfolio, and it did have a huge impact. So it did help USA quite a bit. So we'll talk some about what USA did to try to manage that risk. In the middle of all that, we'll have an exam. We're going to spend some time on credit risk. I don't spend as much time on that because if you're taking John Tui's class, he's obviously going to spend a lot of time on credit risk. But I'll give you a few exercises there, and then a bunch of other risk. And then we'll spend quite a bit of time on these thinkers and case studies. Any questions on the layout of the class? So the one thing you need to do is start working on risk paper 1. So I've cut it back a little bit from a couple semesters ago. It was just getting too massive. So what I want you to do, what you're going to do in this paper 1, you're going to pick a major bank in the United States, and you're going to go into the risk management section of that bank, and you're going to assess 2 risks the bank. I used to do more. I used to do 3, but you're going to do 2 risks. So I used to do interest rate, price, and credit, but I don't do credit anymore. Credit risk is just too massive. You don't go into a bank like Bank of America or Citibank, the credit risk is like 50, 60 pages, and it's massive. And it's because each area has, you have the real estate, you have the small business, you have the large business, everything's so different. So I've kicked that out. So we're going to focus in on interest rate and price risk, and probably price risk is going to include liquidity risk. So how do you find this? So let's find an obvious one. Well, let me show you the banks that we usually use so you can kind of get a sense of, well, what do you think are the banks you want to use? Well, Chase is JP Morgan. So JP Morgan, Citi's struggling right now, right? So would be an interesting one to do. Bank of America. What else do you think is a major bank? So why wouldn't you do Frost? We can look at Frost. I should look at them before class to make sure I got them. I really want to show you how easy it was to do, but I picked the wrong bank. But Frost might have 10 pages, and Citibank might have 80 pages. You're just not going to have as much substance with a bank like Frost. Frost is a very good risk-managed bank, but they just don't have enough substance in their annual report. So what else would you think? American companies, they are financial institutions. You want true banks here.
PNC.
Who?
PNC.
You could do PNC. It's a little second tier. So Morgan, yeah, the traditional investment banks. I'll just say Morgan.
Yes. Wells Fargo.
Yeah, Wells, you can definitely do. Who's the sidekick of Morgan? Goldman. Now, someone said Bank of New York. So banks like Bank of New York, State Street, Northwestern, or the trust banks don't do that. Trust banks are very different animals. Bank of New York is more of an investment firm than it is a bank, so it doesn't really fit. So you want to avoid. You're not going to do BlackRock or Vanguard, those type of firms. We're missing somebody. UBS is a non-US bank, so, and it's more wealth management than just banking, so that's the one to avoid. We're missing somebody. I can't think of who we're missing. Now, when I was in my career, this list would have been 40 banks. It's amazing how many banks have consolidated in the last 50 years. Huh? Who? No, Fidelity's more an investment firm. So investment firms are very different animals than banks, and life insurance companies are very different animals. So we'll think of some others. I'll try to get you a complete list. I'll look at what we did last semester. So a firm like PNC Bank, kind of those second tier banks, you can look at them. They tend to have about 1/3 the amount of information as the big banks.
The U.S. Bancorp.
U.S. Bancorp can fit. It's a little bit on the kind of the second tier, but you can. You probably want banks that are, definitely over 100 billion. Well, probably over $1 trillion in assets, right? We're talking, I don't know if Goldman's over $1 trillion, but we're talking some fairly massive entities here. Y'all know what the assets of JP Morgan are?
Over $3 trillion.
Yeah, it's probably well over $3 trillion now. So $3.7 trillion in assets. That is amazing. So someone has 3.6 trillion assets. So you would think their net worth would be what? 1.5 billion, 2 billion, right? Walmart's net worth is about half of its assets. What is their is their net worth $2 billion. What's their net worth? It's not even $300 million, $300 billion. Their net worth is less than 10% of their assets. Do you see why risk is so important? How much room do they have for error? Not much. That's how many of y'all are 10 to 1. How many of y'all go out and borrow $1 billion and invest 1.2 billion? You probably don't do that, right? That's pretty risky stuff. Here's an entity that borrowed $3.4 billion and has 3.7 billion in assets. So risk management is really, really key. What happens if JP Morgan goes under? Who's going to bail them out? Yeah, there's not many people. It's going to be us, the taxpayers, and it's going to be pretty tough. It's like those Icelandic banks. We had some exposure into the Iceland banks. When those banks went under, their government says, "Hey, tough luck. They're bigger than we are. We can't bail them out. We can't bail out someone who's 10 times larger than we are." So they said, y'all shouldn't have messed up. Sorry, there's nothing we can do. In the U.S., would they bail out Bank of America or JP Morgan? They probably have to do something, right? Because they're worried about the domino effect. So Goldman's probably not that big or even close, but it is, $1.4 trillion. I always tell the story when I was early in my career, so it's been several years, but State Street went over $100 billion in assets, and I remember thinking that just freaked me out. How can one bank have $100 billion in assets? That's just crazy. We shouldn't allow that. And where are we now with 36 times that today? It's just gotten crazy. But look at their net worth again, less than 10% of their assets. These are highly, highly levered entities. Life insurance companies are the same way. $10 in assets for $1 in net worth. They can't mess up. And what are their biggest risks? Well, interest rate risk is a huge one. Credit risk is a huge one. Those are the two biggest risks that they have. That's why Silicon Valley went under with interest rate risk. But credit risk is another huge one. You have a recession, people don't pay their credit cards, they don't pay their auto loans, they don't pay their mortgages. So credit risk is a huge one. We're going to ignore credit risk because it's so complex, but it's a very important risk. All right, let me try JP. I'm going to do Goldman, sorry. Hopefully this one will work. Boy, they're managing risk. I wonder if I posed for that picture or if that was caught in real life. Let me see if I can find it. Sometimes they don't spell out value at risk. There we go. All right. All right. So they've got a section, if I can find it. It's the notes. Let me keep searching. Yeah, we're in the right section. I'm looking for the intro section to it. There's some tables on here you're definitely going to use in your paper. You notice how many times value risk is in there. All right, I finally found it. So it's on page 123. And if you go back, you'll see, I think that's the credit risk section. There's liquidity risk. We'll talk about liquidity risk somewhat. All right, so where's the beginning of it all? Here we go. You can try searching for risk management. It should be in their index. They'll have a whole section of risk management. How many pages is it? I don't know. It's probably these 50 pages. It's a huge part of all of these banks because risk is what they do. Now, what you want to do is find this risk management section. It's so many pages, so reading it in detail is probably going to be a little rough, but I would definitely read closely the introduction part. So your paper is going to be an introduction to the firm and the overall process. That's where this introductory section comes in. That's where you have the board. That's where you have the committees, that we have specific people like the CEO, the chief risk officer, those type of things. You want to try to figure out how do they do this? What is their process? All right, I'll talk about USA's process because I know that one really, really well. But see what they say is their process. They say here, we believe that effective risk management is critical to our success. One thing you might try, which I think is really fascinating, is go find the mission statement for the bank and see if they mention risk in their mission statement at all. You know, firms have their focus, their mission statement, their core values. Where does risk? There's some of these major banks that the word risk is not in any of that. It's kind of interesting. Like at USA, the word risk is not in their core values. It's not there, but there's no doubt that risk is core to what these banks do. That should be in their mission statement, but go and see if it actually is in their risk in their mission statement. So we believe that effective risk management, we have established an enterprise risk management framework that employs, and here's all the wonderful words, comprehensive, integrated. And what is it to do? It's to give you comprehensive risk management processes through which we identify, this is pretty critical, identify, assess, monitor, and manage. That's not the list we're going to use. We're going to use define, measure, mitigate. But that's what their list is. Identify the risk first. So what might be a risk? Might be interest rates changing. That could be identity or risk. Assess it. Well, assess it means what happens when interest rates change. Now, do banks just care about rates going up or down? What else might they care about? Is it just rates rising and falling? What else might you be worried about if you're a bank? Would you care which rates are rising? I mean, what can yield curves do? What do you remember from your economics class? They can invert, they can steepen, they can flatten, right? What's the yield curve doing right now? It's still pretty inverted, but it's gotten less inverted as the long ends come up and the long end came down and short ends. So, you know, so the yield curve is telling you a lot, but for a bank, that's pretty important. And we'll talk about it when we talk about balance sheet immunization. Banks have loans, they have auto loans. You have an auto loan at 5% and interest rates fall, you're kind of happy, aren't you? You got that 5% locked in, rates fall, you're glad you got 5%. Credit cards, if rates fall, you got to cut your rates, right? So that's kind of an immediate rate. You got a 30-year mortgage, rates fall, then you're really happy because you got 5% locked in, except for what? You got a 7% mortgage, you locked it in for 30 years and rates fall, are you happy? Those that took my investment class, what's going to happen? They're going to refinance. Okay. So do people refinance auto loans? Not nearly as much, right? Because so they have these, it's pretty complicated, right? They got to look at everything they're doing. What does Silicon Valley do? They went out, they said, well, the yield curve is really steep right now. Why don't we go out much longer and pick up all the extra yield? And what happened? The short end came way up, the long end came up. What happened to their bonds? They all dropped in price because rates went up. But they were relying on hold to maturity. That didn't work too well for them. We'll talk about that. The accounting standards that really crushed them. So that's the assessment. What happens when interest rates change? That's what we did at USA. What happens when interest rates rise? Oh man, our bank does well, but our life insurance company really struggles. Okay, well, can we mitigate that? Well, they're kind of mitigating each other. So, okay, well, maybe we don't have to worry about that. That's the assessment. You're saying if it happens, what happens to our assets? What happens to our liabilities? And monitoring just means you're going to do it over and over again. So at USA, we had, I thought it was kind of funny. We had the Corporate Asset Liability Management Committee, the CALM committee. I thought that was perfect. CALM committee. We're managing risk. I could never get anybody to show up. We met once a quarter. And then we got a new CEO and he says, I'm going to come to those meetings. And guess how many people started coming to the meeting? He suddenly had 50 people at all the meetings. Really fascinating. He took it extremely seriously, the monitoring. Every measurement we had is like, now why? You mean we're going to lose that much money if that happens? Yeah, sorry. He was like, no, I'm not going to do that. We got to do something to fix that. And then the management, This is the part a lot of people forget in risk management. They have all these wonderful departments measuring, all this kind of stuff, got all these reports, but no one's actually doing anything. It's like, hey, boss, if this happens, we lose $500 million. Okay, thanks, Glad. Thanks for telling me that. Let me know about that next month. It's like, well, you want us to do anything? No, you got to do something, right? That's why you're hired as a professional. It's not just to monitor and measure things. You're supposed to actually make a decision that changes things. So that manage is actually do something. I call this mitigate. I don't have monitor in my list because it's part of my measurement, right? If you're going to measure, you mean monitoring. So identify the risk, measure and assess them in some way to figure out how they impact you, and then do something about it, mitigate the risk in some way. They're saying, this is Goldman, they're saying that's what their risk management process does. And yet they've had some huge blowups here the last few years. So if you do Goldman, you probably want to look at the big, and I can never remember the 3 letters, but the Malaysian thing that happened to them was really massive. Someone can Google it for me. I can't remember. MDB or something. I can never remember which number it comes in. Massive risk that kind of took them by surprise. How did this process that they're spending hundreds of millions of dollars on, why didn't it capture that? If you do JP Morgan, the CEO of JP Morgan, they had that big well thing that happened to them, massive risk, and the CEO said, I had no idea that was going on. What? You got a $3.7 trillion entity and something major is going on, you weren't aware of it? That seems pretty scary. So anything that you have, well, we know Wells Fargo, what have they been doing lately? Fictitious accounts and some pretty stupid stuff, right? These are sophisticated firms that do stupid stuff. When I was an undergraduate, I was just, man, these firms are so sophisticated. Goldman's so sophisticated, Morgan's so sophisticated. They're really not as sophisticated as you think. And it's scary because they're sitting on these massive balance sheets. So what are they trying to do? I don't know how many of them are going to use the word comprehensive, but most of you are going to see the word comprehensive. The word integrated, I guess, sounds good, but integrated just means, they're kind of combining different departments and talking to each other. It's not so easy to integrate as you might think, because most of Goldman is all these stovepipe departments that have their own software, their own technology. Getting them to talk to each other is actually quite complex and quite difficult to do. And then the governance is who's doing what. And usually it's committees. So committees, is that a good way to manage risks? Look at their committees. What's the first thing that jumps out at you? Look at the committees. It's a lot of people. It's a lot of committees. And that's just the high level. I don't know if they show they're more complicated. I can't remember, it's Bank of America that has just, but let's look at the titles in these committees. They have Firm-Wide Risk Council. Then they have Firm-Wide New Activity Committee. They love the word firm-wide. I don't use firm-wide because that's kind of a stupid word. I don't know if firm-wide even a word. Will Bill Gates let you do that in Word? Firm-wide. We use enterprise risk, but firm-wide, Operational Risk and Resilience Committee. What is a resilience committee? We'll talk about that when we talk about tailored and anti-fragile. They have a conduct committee. They have a risk appetite committee. So they have one committee that says, this is how much risk we can take. What did they tell the others? Hey, we decided we can take 50 now instead of 40. That's a strange committee. They have a capital committee. I'm not sure what that would do. I remember in UTSA, they had their list of risk, and one of their list of risk was net worth. Like, what are you worried about? Do you think net worth is going to come in and attack you? I don't understand that. Net worth is not a risk. Net worth is what you're trying to protect. Your net worth is not going to attack you. You're worried about losing your net worth, but I don't want someone saying we're going to try to manage the risk of net worth. No, that's the result of all of this. So I'm not sure what exactly that committee does. They have a commitments committee. But that'd be nice. Don't make a commitment before. You have a reputational committee, suitability committee. Who knows what they're doing? Asset liability committee. Now, all banks have an ALCO committee, asset liability committee. USA even had one called ALCO. I think David Robinson was on that committee or maybe been on the board. All firms have an ALCO committee. But when you look at your bank, read through the committees and is it clear what committee does what? Or is it all mixed up? Is it obvious, hey, this committee is responsible for this one's responsible for that? And they got a lot more committees than this. The way it worked at USA, we had the corporate asset liability, the COM committee. It was responsible for everything. Everybody reported to them. The CEO looked at everything, all of the committees. He made all decisions. Because his idea was, I don't like committees because I can't fire a committee. You tell me who's responsible. If it goes wrong, I'm firing that person. That was his thought. He hated committees. I loved committees because that's how I rose to the ranks. It's real easy to get ahead in a committee-run organization. I'll give you the secret. If you're in a committee organization, it's really simple. You show up to committee meetings prepared, and you will get all the promotions you want. I used to come to committee meetings with an agenda already typed out, even though I wasn't responsible. And the first thing everybody does, because the purpose of committee is what? Free coffee and avoid work. That's the reason we have committees. So you come to a committee hoping to get work, you'll get work and you'll get promoted. So I came to the committee with an agenda and everybody's looking around, what are we going to do? What are we going to do? And I go, well, I typed up a draft agenda and everyone's like, yeah, pass that out. And suddenly I had control of this committee. And then Davis shows up and he's like, I don't like committees anymore. And so now he's making all the decisions. But that was his thought, is I want one person responsible for this because if it goes wrong, I'm getting rid of them. How does this firm focusing? I bet this firm has a chief risk officer. What does the chief risk officer do? Do you see a chief risk officer in there? Why is she or he way over there? What word are they trying to display there? Starts with an I. I'll give you a hint. Independence. The chief risk officer should be independent. Well, is the chief risk officer? If Goldman has some high-flying department of traders and they're doing these transactions, they're making a fortune off of it, but there's this massive risk they're ignoring. The chief risk officer says, no, you're not going to do that anymore. You think they're going to shut it down? Say, no, well, yeah, you're right. We won't do that anymore. Do they really have that kind of power? And where do they go to? They go up to the board. What is the board? Who's on the board of Goldman Sachs? What if it's the CEO of DuPont? What does DuPont know about banking? DuPont CEO is probably I don't know if it is, but DuPont CEO is probably a pretty smart person. Does he or she know anything about banking? Does doing chemicals help you do banking? Do you think there's any overlap there? Who are the board members at USAA, do you think? Smart people, right? But what were they smart in? What did it all start with, their titles? General, admiral, colonel, a bunch of military people. Military people were really smart. I remember I met with one of the board members. He had a degree in statistics. I thought, oh man, I'm having so much fun showing him what we do. He walks in and says, oh, I've forgotten all that stuff. I don't remember any of that. It's like, oh man, I thought we had an expert here, but he's like, no, I don't. How is a person like that? I mean, I'm not saying he's not smart. He's very smart, but how is he going to manage an entity as complicated as USA? Is the board really the place you want risk to be decided when they only meet, once or twice a quarter? The board I worked with on the mutual fund side, we gave them 2 books that thick. We met once every quarter, and they came in with those thick books. You think they read that entire book? There was one person on the board. She was pretty smart. She would find some obsolete page, highlight it, and that was her question. And it made it look like she was really into the details. And she would have one obsolete question she would ask, and she's like, okay, I'm off the stage now. It's like, wow, really good question. On page 637, paragraph 16B, D14, was that she got that question. She didn't say another word the rest of the meeting. I know because they all had other jobs, they all had other stuff to do, right? The DuPont CEO has other stuff to do, don't you think? Besides managing a firm. So you might want to look at their board members and see what is their background. Are they bankers? If they're not bankers, I'm going to say they really don't have much qualification to manage an entity like Goldman Sachs. But that's where is the board in this chart? It's at the very top. So I've always questioned, is the board really the right place to have all this managed? Obviously, senior management is important. The risk officers over here, does that mean they have extra power that they can do things or not? Then you have the committee. Then you have all these firm-wide committees reporting. What else is independent on this chart that you want to talk about?
Director of Internal Audit.
Internal audit. What do auditors know about risk? Any accountants in here? I don't want to step on too many toes. So, is internal audit good at risk management? They've been saying they are, and they've been beefing that up. I'll give you some stories where I might have you question if internal audit is the right department. What is the background, educational background of internal audit?
Forensic accounting.
Accounting. Are accountants taught risk management? Is that part of their curriculum? How many accountants are there in here? I don't see any. So what would be a better department? Some of y'all have had me, Elizabeth and Lauren, y'all know actuary would probably be a better department to put on that. I'll talk about Doug Hubbard and his view of actuaries. So why is auditing over here? Mainly, I think it was just default. They're the ones doing the independent reviews already. So we say, hey, let's give them risk management too. They've already done everything else. Let's give that to them as well. I'm not saying Goldman doesn't do a good job, but I want you to be skeptical and really question whatever they say, if it's really truly there. So definitely read the introduction section. Read through the committees. I don't say you have to get every single word, but read through the committees to see what is it saying. What is this committee doing versus that committee? Are they really, really, really different? I did like USA's approach is just having one group that does everything. No side groups, not breaking it up. And I loved having the CEO there because I knew we had an audience and we could change things. And he was pretty brutal. He asked really, really hard questions. All right, so once you get through the intro part, then you get into the risk I want to cover. Now, market risk or price risk, they'll probably call it market risk. So market risk is one you definitely want to do. Liquidity risk to me is part of market risk, so I would put it there. I would definitely read the liquidity risk section. The other risk I want to handle is interest rate risk. For most of these banks, interest rate risk is part of market risk. So you'll just have to kind of look for it, right? Now we're going to cover this in the class, but I want you to start working on this paper. So what I want you to start thinking about is define, measure, mitigate. So essentially, this is your paper. Overview, a process, governance, right? What do they do? What do they say they do? What's the process? Then you're going to do liquidity risk, interest rate, market risk. And on each one of these, it's going to be how to define liquidity risk, how do they measure liquidity risk, and how do they mitigate liquidity risk? How do they define interest rate risk? If they do, probably what most of them are going to do is kind of market risk, and interest rate risk is going to be a subcategory from the market risk. How do they define it? How do they measure it? And how do they mitigate it? Now let's see what you already know. How would you define market risk? A real simple definition. It's the risk that what? Some of you are probably thinking can't be too simple, but it really is. Well, the economy impacts what? So what are you worried about with price risk? You have a stock portfolio. What are you worried about? It goes down. Yeah, it's that simple. It's the risk that assets go down in value or liabilities go up in value. All right, that's price risk. Are you worried about liabilities falling and assets going up? Well, you might be, because if that happens, the opposite can probably happen. Right. It's hard to think of a scenario where assets are going up and liabilities are going down, where the opposite couldn't happen on the other side. But how did they define it? So looking for that definition, let's see if Goldman does it for us. The critical risk is a be verb, which means it's a definition. There's a definition. Liquidity risk is the risk that we will be unable to fund ourselves or meet our liquidity needs in the current event of firm-specific, broader industry or market liquidity stress events. Now, what does that mean? You gotta look. Does that mean anything? Just looking at it. You might say, well, what's the liquidity stress event? What's a market liquidity stress event? So what happened in the fall of 2008? You got a triple B credit bond, you want to sell it, you pick up the phone to the broker and you ask for a price. And she says, oh, yeah, it's trading at 92. And say, okay, thanks. You put 92, and that's what you put on the books. The next day you say, the portfolio manager goes, 92. Wow, that's a great price. I want to actually sell it. So you call the broker, and what does the broker say this time? Oh, you want to sell it? I didn't know you wanted to sell it. I thought you just wanted a price. If you want to sell it, it's trading for 80, 81. Okay, what? Why? Because there's no liquidity. There's no buyers in this market. The model says it's worth 92, but no one's buying it for 92 because no one's buying right now. That's liquidity risk. When markets just freeze up, how often do markets freeze up? Well, 2008 was a pretty good example of that. 2020, we didn't really have a liquidity crisis. Markets kept functioning fairly decently through that, even with firms losing 80% of their revenue. But market liquidity stress events. So you might be wondering, what is that? So to Larissa's point, we're talking firm specific or even the overall economy or the market. There's some liquidity event going on. We'll talk about liquidity more as we get into that particular risk, but generally you can find liquidity risk fairly easily by asking, what are people buying today? If people are buying a lot of stuff today, that's probably going to be your liquidity risk 5 years from now. When people are rushing out and buying a bunch of real estate's probably going to have a big liquidity crash. When people are buying subprime mortgages, that's probably going to be a big liquidity crash later. So, or Stanley Cups, have you heard of these Stanley Cups? I haven't figured that one out. I don't know if that can be a liquidity crush. I've seen that stuff before in the past, and those things stop pretty quickly. So you read through it. So that's the definition. So what do we want to do next? We want to see how they measure. Do you have a question?
Oh, no, I was just gonna say that the Stanley Cups were the only time I've seen people try to stop the shop with.
Oh, really? Well, in my life, we had the Cabbage Patch Kids and Beanie Babies, stuff that didn't make sense at the time, but I had friends that were like, it's just crazy. And it's kind of like that in finance, though, too. People just get enamored with an asset class. Why? Because we'll talk about, the Minsky moment. I don't know if you've heard of Minsky moments, but people buy stuff and the price goes up, so people buy it, so the price goes up. People buy it, so the price goes up. And then what do? Then they borrow money to buy it, so the price goes up. And then they borrow more money. And then what happens when the price drops a little bit? Well, if you borrow $900 to buy something for 901 and it drops to $899, you're in a lot of trouble. Then you got to start selling really fast, and it unravels very, very quickly. So that's what he's talking about, that type of, or that's what they're talking about, that kind of stress events. How do you measure? This is the tough one. Liquidity risk is the hardest thing in the world to measure. But let's think about market risk. Let's see if we can find their market risk. Now does that sound like a measurement or a mitigation? Contingency funding plan.
Mitigation.
That's some mitigation. What are they saying? That's what we did at USAA. We can't get cash from here. Where else can we get it? So we did at USA. We had a whole list of $20 billion of stuff we could get. Well, if the life company has a problem, we can do this with the bank. Or if the bank has a problem, we can do this with the property casualty company. And one of them was the bank has a serious liquidity problem. The property casualty company will go in and buy 200 million of CDs from the bank. You say, okay, well, let's do that. But can you just do that? Can a parent property casualty insurance company go buy $200 million from the subsidiary without telling its regulator? No way. So what do we have to do? We have to go to the state of Texas and say, hey, we want to know if our property casualty company can buy $200 million of CDs from our bank. Will you approve that? We don't want to do it, but if we want to do it, will you approve it? We have to get that approved in advance. So we have to test these things. We'll talk about that. You can't just say, yeah, we'll do that when it comes. No, if the time comes, say, let's do it. And say, well, wait a minute. We have to get regulator approval. How long does it take regulators to approve something? It can be months and months and months. So, but that's what a contingent. So that's a mitigation. So you see, as you're reading through it, what is the definitional? What is measurement? We're trying to see the size of the problem. And what is mitigation? Some way you're actually trying to reduce the risk. Here's subsidiary funding policies, exactly what we did at USAA. Here's one, stress test. You'll see them a lot. First is, you know what a stress test is.
Basically where you run like a bunch of models to determine if you could handle some sort of crisis event.
Yeah, so models. So specifically on stress tests, because we're going to use stress tests when we do interest rate risk. A stress test is a specific scenario. So the one we're going to do is what if interest rates rise 1%? What if they rise 2%? What if they rise 3%? What if they fall 100, 200, 300? That's a stress test. All right. It's very specific. There are some stress tests that say, what if 2008 were to happen again? Now, what stress tests could you look into? Well, the bank regulators have stress tests, right? They come in and they say, you have to be able to handle this type of risk. You could look those up and see what those stress tests are. The life insurance industry has what they call the New York 7. I think we talked about those some last semester. We'd say these 7 interest rate scenarios, what does your book of business look like if these things happen? So that's a stress test. Does that sound like measurement or mitigation? Definitely measurement. Stress test is a measurement. All of your papers is going to have stress tests. Everybody does stress tests. Your goal is to figure out what the stress test is. The most popular one is rates rise and rates fall. 100, 200, 300, 100, 200, 300 basis points. Y'all know what a basis point is? 100 basis points is what? 1%. So what happens if rates rise and fall? So how do they do that? You'll see these. So you say a stress test, does it happen all at once? Or does it happen, what if rates rise 100 basis points? Is it what we lose in one day or over the next year and those kind of things? So, you know, there's different ways they have to define it. Usually models are measurement types of things. Here's another one, limits. What do you think limits sounds like? We have a $50 million limit. Does that sound like a measurement or a mitigation? Does it? The speed limit on the highways, are they measuring your speed? When you see the speed limit, are they measuring your speed? They're trying to get you to do what? Yeah, stay at that. What does it sound like? Mitigation or measurement? Mitigation. Now the radar gun might be measurement, but the speed limit itself is a mitigation. Limits or mitigations. So you come in and say, hey, the most you can take here is 50 million bucks. If you go over 50 million bucks, you have to cut back. You're actually changing what they're doing. So that's a good way to understand a mitigation. Someone has to change their behavior. Measurement, there's no change in behavior. You're just trying to figure out what they're doing. But mitigation, you're saying, hey, if you exceed 50 million, you got to cut back somewhere and get back below 50 million. I had a student who went up to Austin to do some prop desk trading. And he had this class that he learned value at risk, and he was using value at risk. He had all these prop desks trading all over the place. He was the only one using limits in the entire floor. And it's like, why are you doing this? I just don't, I want to know where my risks are and how much risk I'm taking. And then I want to stay within but everybody around him, they were just doing whatever. No one had a clue how much money these people could lose because there's no limits, there was no measurement. He was like, I'm going to measure, and then I'm going to stay within a set limit. You can't just set the limit if you don't measure, because then you don't know if you're over or above. But he was doing both of those, and he was like, no, I'm going to stick with it. Let's see if we can find market risk here quickly. You can see how many pages it goes. Does this look promising? Market risk management. I call it price risk, but they call it market risk. Any guesses on where the definition might be? I have students lose points on define on this paper, and you can quote them and just put it into your own words. Just, it's not that difficult. Market risk is a risk of an adverse impact to our earnings due to changes in market conditions. Our assets and liabilities that give rise to market risk primarily include positions held for market making for our clients and for our investing financial activities, and these positions change based on blah, blah, blah. We employ a variety of risk measures, each described below. You notice they have several risks identified here, and this is pretty common. Interest rates, equity, commodities, and currencies. Those are the ones you'll normally see. What is the biggest one usually? For a bank? Or market risk? It's going to be interest rates. Credit risk is a bigger risk, but interest rates is the biggest market risk. Credit risk is a separate thing. Interest rate risk changes in the level, whether rates are rising or falling. The slope, is it steep, flat, narrow? And the curvature, now the curvature is kind of more specific points in the curve. What's the 5-year doing versus the 10? Slope is usually 2 versus the 10, but you can actually look at points in between that as well. They're worried about prepayments, volatilities of interest rates. They say it's credit spreads, but that doesn't really belong here. Credit belongs under credit. Although I will say it gets a little confusing on credit risk. Some banks for credit risk, they're only talking about defaults, the risk that someone doesn't pay them back. Some banks' credit risk is defaults and price risk of credit spreads rising or narrowing. So credit risk can include just default risk, and the spreads going up and down is a price risk. So you have to kind of see which they're handling there. But usually on the credit risk, their main focus is default. What do we do with people who can't pay us back? They're not so much worried about price shifts. Equity price risk, they might say that's a big risk, but why isn't this a big risk for a bank? Banks don't buy stocks, right? That's not part of their business model. Life insurance companies don't buy stocks. It's just not a big part of their model. We're going to talk about one of the big questions on the first exam is why do pension plans have 70% in stocks, but life insurance companies that have almost the exact same risk have 0 in stocks? Why is that? Which of those two do you think is the smart one and which one is the foolish one? How would you guess? What did I just say is the best manager of interest rate risk in the life insurance companies? So I'm going to say life insurance companies are right and pension plans are a disaster, but we'll talk about that. They are a disaster. I think the state of California has a $50 billion deficit in its pension plans. That sounds kind of serious for a state that's fretting about an $8 billion deficit and ignoring the $50 billion deficit sitting out there because the accountants don't recognize it. So this is a risk of changes in prices, mainly stocks, but banks don't have a lot of stock risk. Currency risk, it depends on the bank, but banks can have currency risk, and that can be a decent risk. It's usually not a large one. Commodities, a fairly recent one, but people have started breaking out commodities because oil prices have been so volatile. So they're breaking into categories, which means each of these, they may have the same measurement, but calculated in a different way. So anybody guess what the most common measure of price risk there is, market risk there is? What was I searching on earlier? Well, value at risk. Y'all know value at risk? You all remember that? So value at risk is pretty important to these banks. There it is right there. If y'all don't know what it is, there's a definition. UTSA did value at risk, but we didn't call it value at risk. We called it probable maximum loss, PML. It's essentially the same thing. The big difference is for banks, it's a daily thing. For property and casualty companies, it's an annual thing. So value at risk is, back to your stats class, it's the tails of that distribution. So if you have a 1% risk tolerance, where does that cross on the distribution? Is that at $10 million? Is it at $20 million? So value at risk is a measurement that you will all be talking about. It'll be in all of your papers. And there's our confidence level, 95% confidence level. Anybody want to guess what UTSA's confidence level was when I was there?
Maybe like 98.
No, a little higher. Little higher. Little higher. 99 point, well, let me have to calculate it. Oh, I don't know. It should be illegal to take off the num block. So 99.8% was UTSA's. What is UTSA's 99.8 and Goldman's is 95%? That seems a little bit of a problem, doesn't it? 5%, does that sound like if I were to, so your stock market is a 5% chance of losing 30%. You could probably live with that, right? If you're going to go skydiving and say, hey, this company, they do 10,000 a year, and last year they only lost 500 people, only 500 people died. Would you go to that skydiving? Probably not. What if they lost 20? Would you go? That's UTSA's. Hey, we did 10,000 people, only 20 of them died this life. So your risk tolerance is pretty important, right? Whether you use 95 or 99.8, pretty important. Actually, USA, we couldn't actually calculate it. But what Bob Davis said was, I want to be able to handle a 1 in 500 year event. And after that, we get all our money from our reinsurers. We have another 1 in 500 event, and they're all insolvent. And after that, I want us to still be investment grade. That was his goal. We don't know what that probability is. Now, some people say, well, you'll be the only insurance company standing, but that's not true because there's firms like Geico and Progressive that don't do homeowners insurance. And so they'll still be around, but the farmers and the state farms will all be out of business. But that was his goal. And well, he was conservative. We found out later it had something to do with his compensation and how he managed that. That was first on his mind, but he was incredibly risk intolerant. So 95% is pretty interesting. Now, I think one bank, I think it's Bank of America, that does things at 95 and 99. They show you both. To me, 99 is not all that low risk. I mean, that's 1%. If something has a 1% chance of killing you, you're probably not going to do it. If you have a 1% chance of crashing in a plane crash, you're probably not going to fly anymore. That's a pretty high probability. So you have to kind of think, how do you come up with these? Why do they pick 95% confidence? But that's value risk. Value risk is all over the place. It's used to measure interest rate risk. It's used to measure equity risk, currency risk, all these kind of things. We use value risk a lot at USAA. Now, they have these other terms that are really similar. Earnings at risk, economic net worth, these kind of things. What you're going to discover is they're either value risk type of measures or stress tests. They're one of those type of kind of things. So you have to kind of read through it and see what it is. But again, stress testing is used just for everything. They use stress testing for liquidity risk, market risk, credit risk, stress testing, running scenarios. That's what stress testing is. I don't like stress testing mainly because if someone says, what happens if interest rates shoot up 300 basis points? And I say, well, this happens. I don't know what the probability of that is. Is that a 1 in 10 year event? Is that a 1 in 100 year event? If I don't know the probability, I mean, what happens to our entity if interest rates rise 2,000 basis points? Well, it's really, really bad, but is that going to happen? What happens if oil prices go to $2,000? Wow, it's going to be really, really bad, but what's the probability of that? Not great, right? So stress testing has a problem that it doesn't tell you the likelihood of the thing happening. Whereas value risk tells you the likelihood. It's saying, hey, you have a 1% chance of losing 50 million bucks. So I like value risk a little better from that standpoint. And then there's a table you'll definitely want to put into your paper. And here it is right here is the value risk table. All banks will have it. Some do it much better than others. I actually think Bank of America does it the best, which is the reason I was trying to find theirs. But see, interest rate risk is the largest. Equity is next. Currency is pretty close. Commodity prices is actually higher this year and lower last year. And then the diversification effect. What is that? That's the argument that all of these risks, when they're at their 5% worst case, they don't all happen at the same time. So sometimes interest rates will be blowing up, but the stock market will be okay, or commodity prices will be okay. Is that material, do you think? What would their value risk have been if they didn't do that diversification benefit? Would be almost twice as high. So it's pretty critical. Now you might be shocked at how they calculate these numbers, so be careful to read that. Very, very different in banks than what we did at USAA. Property and casualty companies are very, very different. So they do the whole year and then they do the end of the year. And they usually will have some nice, interesting tables. Now, if their risk tolerance is 5%, that means out of 200 days, they expect to exceed this how many times? 10 times. So if they're saying we have a 5% chance of losing $50 million or more, you can expect about 10 days out of the year that they lose that or more. What if their annual report says our risk tolerance is 5%, 5% of the time we expect to lose $50 million, but we never lost I mean, we never had a $50 million day the entire year. Does that sound troublesome to you? Out of 200 days, what's the probability out of 200 days, something's expected to happen 5% of the time would never happen? So either they were really lucky or what? Your calculation has a problem. I think the calculation has a problem. You can get into this. Why? Well, these VAR, you're going to see it. These VAR tests are based on recent history, sometimes the last 100 days. When you have a really nice, smooth year, VAR gets really small because nothing's happened. And then what happens? You get March of 2020 and suddenly, it's kind of interesting to go back and look at these banks and compare their 2020 to the 2019. Because 2019 was a big shock. Same thing with 2022, because what happened in 2022? Interest rates shot up. Interest rate risk. Do you see it in these numbers? You probably do see it in these numbers. Let's look back at it. Do you notice any change there? So 2022 was a little bit of a shock. Does that mean it was unexpected? Well, no, we expect interest rates to become more volatile suddenly. But the way they calculate VAR kind of ignores it. If recently has been stable, then they're assuming it's going to stay stable, and then it keeps. To me, it's not a good way to measure, but that's the way they do it. And then they're kind of interesting in that they say they do sensitivity analysis of their value at risk. So they're kind of doing measurement not of their risk, but doing measurement of the risk of their measurements. Kind of like, we know these numbers are fishy, so we're going to test how fishy our numbers are. It's kind of interesting, but they do that kind of thing. All right, then you get into credit risk, and boy, credit risk is just going to go on. You're going to be very happy I didn't give you credit risk. It's just a mess. I think credit risk is important. You probably should at least read through the first part of it because it is the most important risk. It is the most likely risk for these banks to go under. It wasn't in 2022 because 2022 wasn't a credit event. It was an interest rate event. So the credit risk is smaller. It's just that 2022 was a different type of event. In a year like 2008, credit risk is a big risk because people aren't paying their mortgages. You got all these subprime stuff going on. So credit risk, when it blows up, can be really, really quite horrible. They even talk risk measures. So they may have a section that says risk measures. Guess what you see there? Stress test. Now, they put limits there, but limits is not a measure. Limits is a mitigation, so be careful. They put limits in the wrong way, wrong place. All right, so it goes on and on and on forever. All right, so what I want you to do in this class right now is just focus on paper one. We'll go through the class lectures. We're going to do all the material. We're going to do in class a lot of exercises. But you have a really, really tough paper one that you need to get started on and just start working on it. Some students struggle in my class because they won't like, I do this and I do this and do this. And I'm saying, no, you got paper one, it's massive, start working on it. All right. The advantage of that is that's a lot more like what your job's going to look like than most of your college classes. Most of your jobs, they don't tell you what to do. You can kind of guess how many rubrics you're going to get from your first finance job. Somewhere in the neighborhood of 0. They don't give you rubrics. They may not even tell you what to do. They may say, just go do your job. And you've got to figure out what it is to do. So you got to figure out how do you handle a complex, and your biggest issue is going to be jargon. I'm going to give you some kind of cheat sheets to help you know what the kind of things to look for, but the jargon is pretty rampant. And it's the kind of jargon that you can't just go Google. Because they have their own jargon that's specific to JP Morgan. Doesn't apply to anybody else. And there's some that is industry-wide. So you can't assume you see a jargon and say, oh, I wonder what this means, and you go look it up. You may find a definition that has absolutely nothing to do with what they're doing. You're going to go, wow, that's really strange. I don't know what this has to do with wine tasting or whatever, because they use some terms that have multiple meanings. All right, questions on paper one. Y'all see what I want you to work on now? Thursday, we'll do the seating chart so I can learn your names, and we'll hopefully get the room set up a little bit better. Are there any desks left over there? Is there one? There's one there. We can move these two over. All right, so we'll try to figure it out. All right, I'll see y'all on Thursday. So what I did on Canvas is I went and got all the banks out there, and I gave you the page number. And it's the PDF page number, not the bank's page number, all right, because it gets really confused. So look up at the top, but it says whatever, and it tells you where it starts. For some reason, Morgan Stanley like had an intro section and then the regular section, but the intro section had some really, really good stuff in it. So I put those both in there. I'm not suggesting you go look through all of them to pick which bank you want to do, because they're all equally complex and lengthy. They're all really similar. If you're going to interview with any of these banks, they would be absolutely shocked that you've read this section of the bank, because very few people do that. One of my goals here is to introduce you to the real world of finance, which is far more complicated than the college version. You make money in finance by specializing. That's all I like to tell people. I probably said it in your class. I know a whole lot about very little. That's what finance is all about. You just go deep dive on something. And you have to think about who writes this. Well, it's accountants write this. You know, I kind of picked on accountants in last class, but the internal auditors at banks are really smart internal auditors. They understand banking. They may not be able to do Deere or Tractor or something like that, but they know banks. The accountants write this. So USAA was involved in writing their report, and you got a whole army together writing this. You saw how many pages it was. And they obviously don't rewrite it from scratch every year. They probably take last year's and update it, but it's a pretty complicated document. And you know, they look at what each other is doing and comparing notes and what are you going to report. They report stuff that I think is somewhat surprising, because you would think it'd be proprietary. But who's the audience of an annual report? Investors, right? Debt holders, bond stockholders. So it's for our investors. And you can see that takes a massive part of their annual reports. So that means it's really important to investors. So I'd like to know which bank you're going to do. And I also want you to know which bank you're doing. So if you email me or somehow let me know, I'll put it down and then I'll make sure the class knows. That way, if you're doing the same bank with someone else, I would almost recommend you get together as a group, you know, read and discuss it. You have to write your own paper, but get together and get some ideas. You're trying to figure out what's the definition, what's the measurement, and what's the mitigation. And you can see it got confusing. Sometimes they put limits on their measurement, but limits is absolutely a mitigation. It's not a measurement. And you got to understand what the measurement is. And the measurement's where it gets really confusing, because I think they do the same thing 6 times, but call it 6 different things. So they have these earnings exposure things that they do. To me, that's the exact same thing as a stress test. They essentially do stress tests, but 6 different ways, and then they give it a different name each time. And you're thinking, my word, what is this something different? And you're going, what is this different? And it's really not. It's the same thing. And you're thinking, well, why are they making such a big deal out of this exact same thing? So it gets frustrating. But if you do it correctly in terms of spreading it out, so let's say you got 40 pages, 50 pages to read. You're not going to read 50 pages in one day, but you can read 4 pages over the next few days and take notes as you go, highlight things that can break it up quite a bit. So here's Bank of America, Citi. I'll just show you. I'll do Citi. So it says page 69. Let's see if I did this right. So you load it up. And let's see if it works. Type 69 up there. And so they had actually an index just for the risk management section. So managing global risk table of contents. They have a table of contents just for you. We're doing the market risk, but they have a table of contents just for the risk section. And then they get into it. You'll probably see a chart with the committees. So they have their committees. So, you know, Citi's probably the one struggling the most out of all of these. I really thought Citi was going to go under in 08, but they survived. That was kind of one voice at USAA is like, I don't think Citi's going to make it, because they had some serious problems. They still do. Their price to book, if you look at it, is still amazingly low. You would think a bank's price to book would be above 1. You would think the stockholders value it more than the accountants, but Citibank's price to book is well below 1, while JP Morgan's is above 1. So there's something definitely going on with this bank related to risk.
And yet they have this massive section saying they do it really, really well. So, you know, it gives you something to talk about. So pick a bank, start on it immediately. Don't wait because you have a lot of reading and it's not easy reading. It's jargon, heavy reading. So get used to it. You're going into a field where it's very, very heavy jargon. Some of the jargon's difficult because they're actually doing difficult things. Sometimes it's difficult just because they have their own term that they use just for JP Morgan, and you're like, what do they mean by that? And they're not really good at defining it. So it's not that it's so difficult what they're doing, but it's more of they're not fully explaining what they're doing, and you have to kind of figure it out. So, all right, any questions on paper one? I did put a paper one description out there, and I did want to make one change. I've decided not to do liquidity risk. You can certainly talk liquidity risk if you want to in the introduction section. It wouldn't be bad in introduction to say what are the kind of universal risk, and liquidity is one, credit is one. So you could certainly do that, reputational risk. So I took liquidity risk out, but there is a paper one description that shows you what I'm looking for. So you can read through that and see if that helps some in getting some idea. One thing that's really important is this number 5. There's a place where a lot of students mess up because they don't do anything at all. So I want you to try to be as brutally honest as you can. Do you think they're doing a good job with risk management, or is it all smoke and mirrors? Is it a bunch of hype? And you're probably going to think what most students think, which is why I think they do weekly here, is like, how would I know? It's a complicated entity. I just read it. How in the world am I supposed to know? But do your best. So my guess is if you're reading through the committee structure and it's really confusing and it's all over the place, that may be an indication that their process is not very clearly set, not really well laid out. If you can't make heads or tails of it, probably the accountant that wrote it couldn't, because they couldn't figure out how to write it in an intelligent ways. And I do think some of these banks are pretty scattered. You know, Citibank is probably the most global of these banks. There's a lot of Citibank offices all over the world. It's pretty tough to manage, you know, an office in Singapore, an office in wherever, all over the world, including some countries that, you know, are really struggling with financially and with civil wars and all those kind of things. These are, you know, different languages, all that kind of stuff, different regulations, obviously. So these are complicated entities. They're huge. We're talking multi-trillion-dollar entities with very little net worth. So, you know, it's supposed to be difficult because these are complicated entities. Any questions? You're ready to get into it. So that's all you got to work on right now. You don't even have to read the class notes. So we're going to go through the class notes. So work on this. I love just sinking into one big project, which is what finance is anyway. Just sink into it, learn it, spread it out. That's the big mistake students make is, well, nothing's due next week, so I can not do anything. Some of that took my security analysis class. That becomes a big issue in that class, doesn't it? Well, it's 9 papers, but there's not one due for a few weeks, so I'll put it off. And then they discover, oh my word, I can't catch up. There's no way. So you don't want to do that here. You want to get started immediately, spread it out. When you're dealing with heavy jargon, if you go in knowing, hey, I'm just going to do 3 pages today, your mental ability will be much better, won't it? Say, okay, I know it's complicated, but I'm only doing 3 pages. So I don't have to worry anything after 3 pages. If you do that, you're going to be much more mentally able to get through it. If you say I got 50 pages and a lot of jargon, you're just going to be so overwhelmed. You're not going to ever want to start. You're going to figure out reasons to procrastinate. Say, well, I'm going to start running. Oh, let me check Facebook real quick. Oh, look, blah, blah, blah. And then, oh man, I better text my friend about that. And 3 hours later, you've done three minutes of work. That's not the way to do it. So set yourself aside with no social media and just let your mind get into it. And as I said last class, you're going to have a tough time using Google to help you on this, because a lot of these terms are not going to be defined on Google in any way that's going to help you. You're going to have to try to figure out from the context of what they're writing. We'll talk more about it as we get closer, and I'll give you some hints.
So is it paper one? Are there more papers? Is it a project?
Well, it's paper and project, but I do switch between paper 1 and paper 2, or paper and project. But yeah, I thought about that when I was typing. But yeah. So paper 1 is the only paper. Project 1 is the only project. All right, let's get into an introductory. My goal is to get you in this topic of risk management, it's not really new stuff. A lot of the stuff you've already had, you're going to draw on. You'll see one of the big essay questions we're going to do on the exam. It's going to have you draw on everything you've done in finance into your answer. But what are the primary risk management tools and what are the primary risks we're going to talk about? I do want you skeptical. I don't want you cynical, but if you think about 2008, that was a great example of a risk management in finance where we just really messed up and we made some huge, huge mistakes. You're thinking these really big, sophisticated firms, and yet they messed up royally. Is it because they weren't doing a good job, or was it just impossible not to mess up in those years? And so, I always think the CEO of Citibank, when they were doing these subprime mortgages, he said, well, we know they're not any good, but everybody else is doing it, and we have to do it to keep up with competition. It's like, so you're intentionally doing stuff you know is going to fail, but yeah, everybody else is doing it. USA was like that. USA CEO was like, more mortgages. And the mortgage people, like, these are horrible mortgages. We shouldn't be doing them. Their bosses were saying, no, don't say anything. Just sell them. That was the mentality back then. It was like everybody knew it was wrong, but everybody else was doing it, so everybody was doing it. So does that sound like good risk management for any entity? And then be critical thinkers. That's your ultimate goal for college. Teaching students to think critically is the principal aim of undergraduate education. In the world of modern finance, a love of numbers has replaced critical thinking. That's one of my favorite writers, James Montier. Then Peter Bernstein. I have to bring my Peter out. If I remember, I have his book called Risk Management, the history of risk management. I was reading it, just going to a conference, not thinking anything of it. I go to the conference, sitting there reading his book, and he's the keynote speaker at the conference. I had no idea. I go up, hey, I've got your book. I didn't even know you're going to be here. And he's like, yeah, whatever. And he signs it and gives it back. But he's passed away, but incredible writer, some really good books. His history of risk management is really, really good book. But he said there's too much math and not enough thought about what risk really is about. We have to make decisions with unknown outcomes, so we have to think about consequences as well as probabilities. So think about consequences. You got to think about those tail events. We'll talk about that some here today. Probabilities often say things are impossible that keep happening. So there's a lot of instances that our statistics say that could never happen. It's impossible. There were weeks in 2008 where every single day was statistically impossible. 5 days in a row where every single day did not fit in that normal curve anywhere. You have 5 days in a row which are impossible. You can have maybe one day that's impossible. Everything just aligns, but 5 days in a row, obviously the statistics is wrong. So if you focus on the statistics, he says don't worry about that because it doesn't happen. And then it happens. So love Peter Bernstein. He was such an incredible speaker. He's not an actuary. He was speaking at an actuarial conference. And I remember this one actuary asked him a really technical question. And he goes, well, I'm not an actuary, but, and then he gave this really astute answer, a really impressive answer. Smart man. It's sad that he's not here because he wrote about finance in a way non-finance people could understand. A really good writer could really get his thoughts down. So critical thinking. So that's why this paper one, I want you to try to get between the lines, try to see what they're really saying. My expectations, yeah, sorry, I do want y'all to come to class. I may be the last professor standing. I just don't want to talk to a computer. It just doesn't interest me. And your most important network is your fellow students. I've heard all of my peers, I asked them that. Oh yeah, my most important. I was talking to a friend, I may have said this in my other investment class, but talking to a friend who started a hedge fund in New York, and I asked him, we talk about networks. What was your most important network? And so, it's my college buddies from so-and-so. They were the first people I called when I started my hedge fund. So you need to get to know each other. It's hard to do that on Zoom, but sorry, that's just my philosophy. Do be prepared. I'm not telling you need to read the class notes, but you certainly could read ahead if you wanted to. I'll give you an indication what you could, but I'm going to go through the class notes in class. But as we do terms in class, I do encourage you to go do Google searches, and I'll try to help you what to actually search for. Investopedia, Wikipedia are good, but some of these topics get really specialized. You can find really good research reports that go much, much deeper. Don't be checking Facebook and those things during class. It just irritates me. I bet you could make it 75 minutes without a Facebook like. I bet you could do it. So don't be a smartphone zombie. Try not to leave in the middle of class. I mean, I know sometimes emergency, but if a student leaves in middle class, I assume they were just offended by what I just said. And so I'm thinking, what did I just say that make them leave? I want exceptional papers. I want you to write extremely well. If you're not a good writer, become a good writer, because finance is a lot of writing. Be engaged. And if you're not engaged, pretend you're engaged. I know you guys don't have anything to write, no table, but have something to write on, notes or something. Just make it pretend like I might say something intelligent. And then you have to just trust me that I'm covering the most important stuff. I think I am. I've been retired for 15 years, but I still talk to my friends in industry all the time. I'm always, and now even what's even more interesting is talking to alums, because our alums that have been teaching the last 30 years, they're moving up really high in business. It's pretty amazing. When I was in New York this last summer, I remember I saw Diana. I go, what are you doing now? And she told me, you gotta be, my word, it's crazy. You're like 32 years old and you're already in that position. That's crazy. She had an incredible job, just really amazing. We have some really high ranking people. And so just talking to them, what are y'all talking about? What are y'all worried about? What are y'all doing? So make sure I'm not missing something that we should be doing in the class. And you can let me know your expectations. I don't know what irritates you most about a professor. Maybe it's that he takes attendance. That's not negotiable. But beyond that, I do try to grade papers pretty fast and get them back to you. I think I do that fairly decently. So if you turn in a paper on Friday, you'll probably have it back by Tuesday. I don't give a lot of comments on the paper just because the class is too big. But if you do want to go in detail, in fact, I'd recommend, if you're scared about the paper, set up a Zoom with me before it's due, and we'll go through it in detail to make sure you don't have any major missing pieces. I'll show you some example papers and what you should do, and make it how you can make it look professional. I'm trying to organize Canvas better. I'm getting used to it, but if you see anything there, I've gone into the modules this time. I don't know if that makes it easier or not. I don't know what else irritates you about professors, but if you have something, if it's that I talk too fast, I don't know how to fix that. So I could take a Valium. What is a Valium? What is it that slows you down? So is that the wrong direction? So I don't know what I could take. I'm so excited about finance. It's like the greatest field you could possibly have. So when I get excited about a topic, I start talking fast. You can say slow down, professor, too fast, and I'll definitely do that. So if y'all have any other expectations, let me know. As far as the paper, I say it's coverage, clarity, and critical thinking. This one, the coverage, is a big part. You got to do define, measure, mitigate. That's got to be in there. But I do look at organization, visually organized. This is a great paper to put on LinkedIn. It really is. So you don't want it to look like a college paper. So what's a college paper? The most obvious thing is double space. That's the worst thing. You should never do a double space paper the rest of your life. There's nothing that looks more college, even high school, than double space. So get rid of the double space. I think some students is double space with 1.5 inch margins so they can get as many pages as possible. That's not what you want to do. It looks so unprofessional. So just don't do that. Paragraphs need to be short. You don't want these 20-line paragraphs. It just looks terrible. I like the 2 columns. Some of y'all have seen this format, right? I've kind of become the, see if I can find an example. Maybe last semester I did one. Here's one from my investment class. I like this format. Have y'all seen this before? I guess everybody's had me has seen this before. Try to make it as much, I think, I don't count off for the formats not like this, but I would try to make it as much as possible look like a professionally published paper in a journal. A good abstract. The abstract can be either, this is what I'm going to do in this paper, or the abstract could be, this is what I found, kind of your summary of what you're gonna do and then get into it, something that gets the reader going so that they know why you're doing this. And then good use, this won't help you because it's a different paper, but good use of bolding and titles. And you notice 2 columns, full justified, really thin margins. You need thin margins just to make it look as much like a professional journal piece as possible. I've had other professors are complaining, we keep seeing this format from your students. Why are they doing that? One said she didn't like it because she had to read down the page and then come back to the other side. And I said, yeah, that's not a big time commitment. It makes the paper look a lot better, but I don't know. I mean, would you be embarrassed to have this on your LinkedIn that look like that? I mean, doesn't it look pretty professional? The quotes, if you're going to quote, a long quote, italicize, center, separate it so it stands out. This isn't a good chart here, but he did have some good charts here where he labeled them well. So you want it to look really, really professional. I'll show you an example of the paper one from this class, but later once we get further along. I don't want to overly influence you, but use of titles, subtitles, make sure your paragraphs. I think of it when you have 2 columns, you have a little bit longer paragraph, but once you get beyond 10 lines, it just starts getting way too long. So don't have, you can have a 2-3 line paragraph. You don't want a 15-line paragraph. And I say that as someone that reads a lot of papers. It's really, really difficult to read a long paragraph. And some students, their paragraphs are so long, I actually hit enter just to create paragraphs so I can read it because it's just way too much. Your brain just can't, because you think what I'm doing, I'm grading, so I'm looking back and forth, and I got to now find where I am in that 40-line paragraph. No, break it up. So if you quote, here you're quoting the bank's annual report, more than likely. There may be other things you would quote, maybe, but most of it. All you need to do is just put the page number you got it from, and that's more for you, so you can go back and find it. So do keep track what page you're reading from. So if you quote exactly, put the quotes around it and just in parentheses, page 16 or whatever. That's all you need here. We don't need a full-blown bibliography on this. If you quote something else, like you hear the CEO say something in an interview or something like that, then you can give me a little more description, but I still don't need a full-blown bibliography. Bold terms, here it's pretty obvious. We're talking define, measure, mitigate. To make that real clear, here's the define section, here's the mitigate, and what really helps, say mitigation, this bank has 6 ways, measurement. This bank measures risk in 6 ways. Have a list of them, and then you do each one of them. So it's real obvious what your organization is. No fluff. I don't grade on number of pages. This is going to be a lengthier paper, but 12 pages doesn't give you more points than 10. In fact, it might hurt you if it's just fluff. It's not saying anything extra. So you remember the old famous saying, I would have written a shorter paper, but I ran out of time. Your paper should get shorter each time because you get more succinct. Avoid unnecessary repetition. And then in critical thinking, you're going to amaze your professors if you put your thoughts in there. And the way to do it is start thinking phrases like this. These are really good phrases. I find it interesting that you have some professors, if you put that in a paper, they'd probably pass out reading your paper. It's like, wow, a student found something interesting, because students seem so bored when they write their papers. I was surprised to learn. I wonder if that's really good for this first paper. I wonder if this committee really overlaps too much with this other committee. That wonder if means, you're not definitively saying, I think JP Morgan's all messed up. They don't know what they're doing. That's an undergraduate college student. That may be a little bold, but I wonder if gives you a way to criticize without it make it sound too arrogant. I was curious to see, I was amazed at, that's kind of the same thing there. I question if's kind of the same as wonder. I think they should also consider something along those lines. I think it is unique strength in their process. This is similar to what we discussed in class because professors love that. Like, it's interesting, we talked in class this very thing, and they're doing something similar. That connection, that's a critical thinking thing. You can connect two different things. this contradicts what we said in class. That makes me even more excited when I read something like that. This seems to contradict, I mean, if you're not sure, because I'll be going, no, this isn't contradict. I said that exact same. So if you want to be careful, say this seems to contradict what we said in class, blah, blah, blah. That's a powerful thing to do. Anything you can do that's outside of reading is always good. A critical thinking exercise is to take a really complicated financial sentence and reword it in your own words. If you're not sure, you can use words like, what I think they're saying here is. So you can say you're not 100% sure, but I think this is what they're saying in this complicated sentence. So, or I'm not sure what they mean here, but I think it means something like that can certainly help. So if you think in these terms, what you don't want to do is write your paper and then throw these terms in randomly, because that really sounds weird. But you might think of this list as you're writing. What do you find interesting? What do you find surprising? That gets that critical thinking going versus I'm just going to summarize these 50 pages. That's really boring. Instead, I'm going to interrogate this bank and see what they're doing, how well they're doing, if there's something I can learn from it. If there's anything that's going to surprise me, what is surprising about the board, who's on the board, what's their background, those kind of things. That would be really powerful critical thinking. All right. Any questions on anything up to there? It looked like catatonic, like you're shell shocked, but that's good. The more difficult, I always tell students, on jobs, if it scares you to death, you take it, right? You got 3 job offers, take the one that scares you the most, because finance pays for complexity. It's a wonderful thing about finance. The more complicated it is, the more they pay you. And if if you're offered a job and you're thinking, I'm not sure I can do this, that's not your problem. That's their problem. Unless you lied in your resume, you said you had a PhD in stats and you don't. If you're honest and they offer you the job, they think you can do it. That's their problem. Just take the job. The more it scares you, the better it is. And then remember, and the thing I figured out pretty early in my career, remember you're sitting there 50 hours a week. You're going to figure it out. The first week may be the most miserable week of your life. But after 2 or 3 or 4 weeks, you're smart people, right? You're sitting there 50 hours a week. You're going to figure it out. If you don't figure it out after 3 or 4 weeks, you just change jobs because it's probably not going to get there, but you're going to figure it out. I figured out some really stuff that was way over my head, but especially with me with the actuaries, I just kept going back, especially this one guy named John. So again, John, I'm not getting this, and he would give me hours of his time, and he would say he was dumbing it down for me, and he would dumb it down for me. So okay, I think I got it, and then I'd leave, and then 10 minutes like, wait, you were saying this. You just got to do that. Every opportunity you have to learn complicated stuff. So this first paper is really that kind of thing, and you want to get that critical thinking going. So all right, I gave you a few websites. Glenn Holton, we'll talk about one of his articles a little bit later. He has a webpage with a pretty good definitions of key terms that might even help you on paper 1. This website here, you might jump to for paper 1. I'll talk a little bit more about it here in a minute. It's the New York Stern School of Business. They wrote a really good book on bank risk management, and they have a website that you can I've actually not tried it yet, but you can click in the name of a bank and they'll give you an assessment of their risk management. So you might try that with your bank and see what they say. It could be really, really interesting. I'm going to talk a little bit more about CMRA. Just interesting firm. Let's see if their website is working. It was down for a little bit there. Yeah, there it is. So, well, I remember Leslie Raw. Oh my word. Our firm was hiring one of these firms. My boss and I went to New York. It was like 90 something degrees. We're in suits. We're running from building. I'm just soaking in sweat. And we talked to Oliver Wyman. We talked to Tillenhouse. And then I'd never heard of it. I knew Oliver Wyman. I knew Tillenhouse, but I'd never heard of this firm. And we met with them. Oh, I was so intimidated. When I walked in, it was Leslie Raw and Barbara. I forget her name, but these 2 founders are sitting there. And I don't know if you just sat and someone starts talking and you go, okay, they're out of my league, their intelligence level. So I just sat there and didn't say anything because I was worried if I said something, they go, wow, why'd you bring this stupid guy with you? But impressive. This is a very impressive firm. This is the firm, when Lehman Brothers goes under, like in 2008, they call this firm to figure stuff out. They step into a really complicated firm and look at everything they own and they figure out what this firm is doing. Very, very sophisticated firm. Barbara left and they got this guy, Peter. I never met him. He wasn't there. I mean, PhD in economics. I don't know what her background is. MIT. Just very, very impressive people. I don't, these are newer. She's got more people working for her now. Just an impressive firm. We couldn't hire them because their expertise was a little beyond what we were looking for. We ended up hiring Oliver Wyman, which is another very, very impressive firm. But their website's very interesting. They've got some good stuff on their website that I find really interesting. Hubbard, we're going to talk quite a bit about Doug Hubbard. I spoke to him once, called him on the phone, got his secretary, was asking her questions, and she says, well, he's in his office, you want to talk to him? And I said, yes, I want to talk to him. And so I got to talk to him for quite a while. Really, really, you're going to watch a video of his later in the semester. Very, very impressive. I recommend, you'll see his books. I highly recommend his books. He's a very, very good writer. And so getting the books, yeah, Bernstein wrote Against the God and Capital Ideas. They're getting a little dated now because he published them some time ago. I still think they're good books. They're probably worth it to read. He did do an update on Capital Ideas, but I haven't read that. I just read the original one. I found it as a good refresher for my undergraduate work because he covers finance. Sometimes I'm tempted that we should teach finance like this. He teaches finance chronologically. So he says, we learned this, and because we learned this, now we can do this, now we can do this. So he builds on, why did Markowitz have to come before Sharpe? And why did Black and Scholes need to have CAPM and then reject CAPM to come up with the Black-Scholes model? He goes through all that in the book. It kind of opens up your understanding of finance because we teach finance like what we know today, but we don't teach it like how we learned it in steps. So that book does a good job of doing that. Caleb, we're going to talk a lot about Caleb. I like Fooled by Randomness. I thought that was his best book. Most people know his Black Swan. We'll talk Anti-Fragile. I don't recommend Anti-Fragile, but I love the concepts. We'll talk about the concepts, but I don't recommend them in the book. Have y'all read Black Swan in here? Fooled by Randomness, anyone? Rob, did you read both of them or Black Swan? Yeah, there is some overlap between Black Swan and Fooled by Randomness, but you might want to try it. He has one other book and I'll talk a little bit about, but it's a really bizarre book, so I won't do that. But he has a few things in it. Kahneman, more than reading Kahneman, I would say watch Kahneman. He has some really good. We're going to talk about some of his videos. He has some really interesting videos out there, including his Nobel Prize winning video. You really need to read Thinking Fast and Slow. You hear it referenced all the time. It's a pretty famous, important book. Have any of y'all read that one yet? So it's a good book. That entire book, though, you can find him talking about it on videos, but not all at once. So you have to watch like 3 or 4 different videos and you can get the entire book on that. His Nobel Prize covers probably about half of the book. He has a TED Talk where he covers one important chapter in the book we'll talk about. And then I found him speaking at a commencement where he talked about prospect theory. It was a bizarre commencement. He walks up to do the commencement speech, doesn't congratulate anybody. He walks up and says, so what I was thinking about with prospect theory is, and he goes into the entire, it's like a college lecture. It was very bizarre, but it was really helpful if you're trying to learn prospect theory because he goes through the whole thing. Or you can just get the book and read the book. He came up with a follow-up book called Noise that I don't think he actually wrote. I think other people wrote it and he just put his name on it. It's not as good of a book, but he might do it. And then any of y'all Michael Lewis fans? So Michael Lewis wrote a book about Kahneman and Tversky. I don't like Michael Lewis because I'm not into the kind of the soap opera side of finance, but this is actually a pretty good book because he talks about Tversky and Kahneman, just this famous duo going out there and testing all this stuff, and he gives some pretty interesting background on how the two of those work together. Tversky would have won the Nobel Prize, but he passed away. You have to be living to win the Nobel Prize, or he would have won it as well. It's a good book. Have any of y'all read this one? No. Do y'all read books other than textbooks? Like I don't know why y'all read textbooks. They're about as boring as you can get. And then my newest favorite book, I know some of y'all read this because I pushed this book so much, but Annie Duke, any of y'all read Annie Duke yet? Really good book. We'll talk quite a bit about her. We're going to have one entire lecture. We're going to talk about what she has to say. So Kahneman is the theory. Annie Duke is the application. How do you take Kahneman and actually apply it so that your life, and her goal is statistics. She's saying, you got to make better decisions. The better decision doesn't assure your success, but if you can go from a 47% chance to a 53% chance, and you accumulate that over decades, you're going to be a much better place 20 years from now. And that's what she's saying, is improve the quality of decisions statistically so that 20 years later, you're in a much better spot. It's true, a good decision can work out bad because of bad luck, and a good decision can work out well. So you have to make sure you're assessing the decision and not the results, because it's the decision that's going to influence. So it's a really good book. I highly recommend it. She has a second book I don't like. She wrote the same book twice. And so I don't recommend her second book. I was so disappointed. I've heard her at conferences. She's a really good speaker. I'd love to get her here to speak. She's probably too expensive now because this book is so popular. So she's a very good speaker. So you might Google her or YouTube and some other. She's spoken at several conferences now. She's a pretty common conference speaker. So interesting person. And then a huge fan of Doug Hubbard. I recommend both of these books. Very important. I would probably start with How to Measure Anything and then go to the Failure of Risk Management. We'll watch his video. It's more the How to Measure anything. What he does is he takes what we've learned from engineering, actuarial science, finance, all these different fields. He brings them together and say, how can we make better decisions? Very similar to Annie Duke. How can we make better decisions statistically? We know we can't make perfect decisions, but this is a statistical thing, moving yourself up to a higher probability. How can you do that? And he has some things. He's quite controversial. There's things that USAA does that he really bad mouths in there. I agree with him though, because when I was at USAA, I didn't think it was actually doing anything for risk management. So we're going to study him a little more detail, but I highly recommend both of those books. And then this guy, I heard him, actually, he was at a conference with Annie Duke. And the two of them were talking about their latest books, which, they're kind of selling their books at a conference. So he sounded pretty interesting. I didn't get overly ecstatically excited about his book, but there was some good stuff in there I thought was pretty good. So a little more about biases. Annie Duke talks about that as well. And then this one, you're not going to believe that I recommend this book, but I actually recommend this book. This book sounds horribly boring. I found it really interesting. It's called Regulating Wall Street, the Dodd-Frank Act, and the New Architecture of Global Finance. Doesn't it sound wonderful? Buy it for your art history friends for their birthday and say, hey, you should read this book. They won't like it, but this book was amazing. Well, one thing that's interesting that it's shorter than the Dodd-Frank bill. So a book about Dodd-Frank is shorter than Dodd-Frank. I found it really fascinating because it doesn't go in detail into the bill. It does it at a pretty good high level, but then it critiques it. What did it get right? What did it get wrong? And then they show their model that I just showed you with the link. And they said if they would instead have used our model, it would have prevented 2008. And that's part of what they're asking. If Dodd-Frank had been in place before 2008, would it have prevented 2008? And their argument is no, it would not have. You have this massive bill in response to 2008 that would not have addressed 2008. And they say, here's what would have worked. I find that pretty fascinating. Plus, if you go into an interview with a Wall Street bank and tell them you read this book, they'll probably be pretty impressed that you read a book like this. Like, what are you reading right now? Well, I was reading Regulated Wall Street. It's like, why are you reading that? They might think you're a little strange, but they'd be pretty impressed. So it's not as tedious. I actually found it a pretty interesting page turner. That was pretty interesting. Now I know you hear New York Stern, you're thinking the motor end, but the motor end has nothing to do with this book. It's some other professors at New York Stern. So there are other professors, finance professors at New York Stern besides the motor end. So I do recommend that book. I don't know if I put my recommended book reading list on Canvas, but I'll put it out there if I haven't. It has some podcasts as well that you can read that are really, really good. I was showing an actuary today. There's actually a really good actuary podcast called Not Unreasonable. And it's like, man, there's a podcast for everything. There's actuaries talking about property and casualty insurance on a podcast, and it's really, really good. So I have my list of podcasts that I recommend. Okay, so let's get into risk management. I'm going to start with this TV show, Deal or No Deal. Have y'all heard that show? Any of y'all seen it? All right, so just to quickly explain it, there's, I forget, 50 boxes. I can't remember how many, but so there are attache cases or something, suitcases. And one of them has $5 in it, or not $5, it has a piece of paper that says $5. And one of them has 4 million, everything in between. And you pick a suitcase, and if yours has 4 million, you go to the very end, you make $4 million. But you don't know what's in your box. But you can open all the other boxes, and they have these people. I say people, they're usually one gender, but maybe, you know, a group of people with the suitcases, and you pick one of them, they open it, they open a 5, you're really happy. Because that means you don't have the $5. And now the bank's going to try to get you to get out of the game, and they're going to make an offer to you. And so this lady had 6, I would show you the video, but they keep taking this video off for licensing reasons. So I can't show you the video. It's really a pretty humorous video because I can't remember which, but it was her husband and her dad were just having a fit. And they were just, I think the two of them were going to fight over what she should do because they didn't really agree. And she's asking him, what should I do? And one's like, honey, you should just take the money. The other one's like, no, go, go, go. So it was very, very stressful. So she had these 6, and the bank said, if you stop right now, we'll give you $701,000. Now, her choice isn't between $701,000 and opening her box. Her choice is $701,000 at opening one other box. If she points and opens another box and it's $5, what's the bank going to do? They're going to increase it probably about $170,000. If she opens another box and it's got 4 million in it, what happens? The bank's going to drop it about $600,000. All right. However, if she opens 5, 300, 10,000, 20,000, the bank's probably going to jump at 100, 150. So she's got a 67% chance, a pretty high increase. If she opens $1 million, the bank would drop it, but not nearly as much as if she opens the 4 million. So she's got a chance for a pretty large drop. But she has a high probability of a high increase. She's got a small probability of a large decrease. So it's very skewed. It's negatively skewed. I'm not going to ask all this, but I have asked in the past. I won't even try it, but I always like to ask this class, what would you recommend that she do? And in the past classes, I got all these recommendations, and students did not refer any at all to their previous finance classes. And I thought it was interesting. Here you have a decision involving money and risk, and finance majors don't think there was anything in their finance classes that helped them with that. And I thought that's kind of interesting. Could you use your finance classes to help with this decision? So there's definitely some finance here. What would we call the $701,000 in finance jargon? The risk-free offer, risk-free rate. She can take that. We can certainly talk about skewing. This is negatively skewed as far as there's more small boxes there. So if she opens one more box, she's got more opportunity for up than down, but she has one big risk. The bank's offer is lower than the average of these 6, but it's much higher than the median. So when you know when the average is much higher than the median, you know you got a skewed distribution, very positively skewed. You can just look at it and see. So the median is 17,500, but the average is 839,218. What do we call the average in finance? You all remember? The mean. The mean, what else do we call it? Starts with an E, 2 words. Expected value, expected return. Why do we call it that? What's her probability of making $839,218? It's zero. Why do we call something that has a zero probability the expected value? So that's a strange term. I don't know why we do that, call the mean, but the expected value, but the expected value is 839. She's not going to get that. On average, if she played this game every day for the next 50 years with those 6 left, yeah, that's what she'd get on average, but she's only playing it once. The other thing is, this is the average of the 6, but she only has to open 1 box. So that makes a big difference in the decision as well. So if I were making this decision, my most important thing is gain versus loss. It's upside versus downside. So, and I've tried this and I've looked on the internet. I had one student said they found something, but I can't remember what they found. But my most important thing, if I had to spend money, I would be spending money on the bank's algorithm. Because what's the one thing I would want? I want to know the bank offer at each one of these. What's the bank offer if I open a 5? What's the bank offer if I open 4 million? What's the bank offer if I open 1 million? I want to know that. I want them on my upside versus my downside. We know you have a much higher probability for the upside, 67%, but the downside is a much bigger loss. Now, because of that, different people will make different decisions. So it kind of depends. There's some people who said, yeah, I'll just go to the very end. How many of y'all would go to the very last and say, I don't care what's going on, I'm gonna take the risk. I've got the $4 million. Any in here that would do that? How many would take the 701 and go home happy? About half the class, over half. Now, what they discovered is once you go on a game show, you become more risk seeking. So you might actually change because of all these people looking at you. Now, she said something on the program I strongly disagree with. She says, I should go on because I came here with 0. Does that matter? Does it matter that she came with 0? What matters right now? The only thing that matters right now is what? $701,000, right? It doesn't matter if she came here with 0. Right now, she has $701,000, right? I had a high school teacher who was bragging to me, he's 5th grader. He was bragging to me about how he's teaching stocks to his students. He says, yeah, tell them it's not a loss until you sell it. Like, no, they lost money. If you bought a stock at a $500 and it's trading for $50, you lost $450. You're not selling it doesn't keep you from, you just lost $450. It could come back to 500, but right now you've lost $450. But he's like, no, those are paper losses. We're going to talk about that when we talk about Orange County and his term paper losses. No, you've lost money. The market thinks that thing is worth $50. The fact that you, one person out of millions, think it's still worth $500 is a pretty weak argument that you haven't lost any money. So she came with 0, but now she has 701. That's her decision criteria. The 0 has nothing to do with her decision. The fact that she brought that up in her decision to me means that she's being kind of psyched out by being on TV and all that. So she was a very smart player. I could tell she was saying a lot of good stuff, but that was the one thing she said. I was like, okay, she's got the wrong criteria. There is no optimal solution here, but there's certainly decisions on the upside downside risk that you'd want to bring into consideration. So she took the 701, and then they do the thing as, well, what box would you pick next? And I don't know if you really know what box you would have picked next. The next box was a good one that she would have had a higher increase. And then the next, she didn't have the 4 million, so that kind of thing. Almost, they have to do the next box because it's a TV show. But if I were playing, it's like, I don't want to know. I just want to go home. Would you want to know? You want to say, let me see what's on, I might say, show me what's on my box, because there's, a pretty high probability it's less than 1 million. Would that make you feel better? You only had $5 in your box, so there's a psychology to this. There's a psychology to investing as well that we'll talk about, how people really think about risk versus what finance says about risk. And I think they're 2 different things. So, so how would you make these decisions? This is a financial decision about money involving risk. And you got to lay out the thing. And what I think is real important here is what information don't you have that you need to make the decision? Doug Hubbard talks a lot about that. The value of information. What's the most important information you need? Where's your biggest uncertainty? How much would you be willing to pay to get that information? Here, I'd be willing to pay to get the bank's algorithm. I couldn't figure it out just watching the show. Their offer is always less than the average of what's left. So that's one thing for sure. And that kind of makes sense. The risk free should be lower than the risky offer. So that kind of makes sense. But the exact amount, I don't know. The TV show, I think, is fake because, you know, she opens the box and they like take all this time, like the bank's up there, he like sweating and thinking, but I'm pretty sure he knows the second they open the box what the next offer is. I can't imagine the TV show is saying, giving one person up in a box that decision to make. So I'm pretty sure it's probably, and there's, you know, the insurance company and all those kind of things back there. That's one aspect of finance. I want to show you another aspect of finance.
So what was her box, by the way?
I can't remember. And I can't watch it anymore because they took it off for licensing reasons.
It was she had 1 million in her box.
Did she really?
Yeah.
I don't remember it being that high. Okay. She seemed happy that she stopped, but all right. So I want to use a TV show, a movie that probably none of y'all have seen. It's Spielberg's first movie. Have y'all heard of Spielberg? Okay, I don't know. It's like E.T. Y'all never seen E.T., have you?
Yeah.
All right. So Spielberg, very first movie, very low budget, really good movie. Have any of y'all seen this, The Duel? You should go watch it. Anybody who's seen it? Anybody?
This is one where there's like.
Well, don't give it away yet. So, Dennis Weaver. It's a really good movie. You can, I mean, given his budget, it's a really, really good movie. So what I want to do with this is talk about conventional risk management when it doesn't work. So this is Dennis Weaver. I don't know what his character's name is, but Dennis Weaver, he's in a road rage incident. He passed this 18-wheeler and the driver didn't like it. And for the rest of the movie, this 18-wheeler is after it and risking his life. And Dennis Weaver is like, okay, I'm going to use conventional risk management. What's that? You call the police, right? That makes sense. Say, I'm being attacked, road rage. I need some help here. So, and what I love about what Spielberg does in this movie is you never see the truck driver. You see the grill of the truck, which has kind of a face. So that the evil person in this is actually the truck itself. You never see the truck driver. So he does that really effectively. It's really amazing. So let's see how good this conventional risk management works. I don't know if the sound is up or not, so we'll see. You can hear him talking to the police here. So how did it work? That's conventional risk management. And supposedly in the movie, Dennis Weaver was actually doing that. What they told the trucker, if this is a true story, talk about risk management. They told the trucker, if Dennis Weaver is still in the phone booth, when you hit this line, you need to turn off. So, you know, if he had tripped or something, that sounds pretty, and it wasn't a stand-in, it was actually Dennis Weaver, but I don't know, that's kind of folklore. But, so I want you to think, you know, your career is probably going to face this. There are times in risk management when there's only one objective. What is his one objective? Survival. There are times in risk management you throw everything out that you learn. You only care about one thing. That's 2008. That was Lehman Brothers, AIG. It's survival is the only thing you care about. So we'll talk about why risk management fails so much, and it's on the tells. There's times on the tells when things happen where our financial theories can't handle them. They say they're impossible. They're not even in the picture at all. But they happen. And they happen with much more frequency than they should. 2008, we had several of those events. 2020 with COVID, we had several of those events, things that could have never happened before. You know, you think about the jobless claims, the highest jobless claim we'd ever have was like 700,000. And in March of 2020, it was 7 million. That's off the charts. That's a crazy, crazy experience. So how did he do? You want the end of the story? So don't listen if you don't want to hear. So because this is unconventional, he used unconventional risk management, which is what you got to do. You got to forget what the books tell you. And so in the end, he wins. So you have to watch the movie. So I just gave that away. In the end, he wins. But it's really Dennis Weaver is by himself this whole movie. It's kind of, I don't know if he's still living. He's probably passed away by now. You probably never heard of Dennis Weaver. He's a pretty famous actor during my lifetime. Good movie, especially on the shoestring budget that it was made. It's a really, really effective movie. If you want to find that scene, just do Spielberg dual snake scene. This is the snake scene because that lady has snakes in all of her boxes. But anyway, now you might think, why didn't you just call him a cell phone? Why didn't you call him a cell phone? This is a 1970s movie. They didn't have cell phones. You don't even know what that thing he was in, do you? It's like, what's he standing in? So, all right. All right, so let's talk high level risk management. What is risk management? The definition has changed dramatically. When I started my career, my first finance job, I sat next to risk management. And risk management was a guy named Jerry. That was it. One guy named Jerry. Now at USA, risk management's over 1,000 people. So something's changed. Why did they go from Jerry to 1,000 people? I think Jerry retired, moved to Costa Rica. So what did Jerry do and what are the 1,000 people doing? Was he just really good at his job or are they doing other things? So here's how the definition has changed. It's a general management function, which means includes a lot of things. It's pretty open-ended now. That seeks to assess and address. So Jerry didn't really assess risk, he just addressed it. So what do you think Jerry did all day long? He did one thing all day long. Any guesses? He bought something all day long.
Insurance.
Insurance. That's all Jerry did. He bought insurance. Bought auto insurance, bought pollution insurance, building insurance, liability insurance. That's all he did. He didn't try to reduce those risks. He didn't say, hey, we need to have some fire marshals here, or need to make sure people were safe in their jobs, those kind of things. He didn't assess, and he didn't look at causes and effects. He didn't care about that. He was just like, here we are, this is what we do, how much are you going to charge me for the insurance? What did he do with risk that didn't have insurance? Not his problem, right? If you don't sell insurance for it, not his problem. But he bought the insurance, and that's all he did. And then they use the term uncertainty and risk. So what's the difference between uncertainty and risk? And this gets really philosophical. You can read, in fact, Glenn Holton has a really good article called Defining Risk, where he gets into this philosophical, the difference between risk and uncertainty. The traditional approach is risk are those things that we can put probabilities to pretty reliably, like playing cards or playing dice or something. You can put the statistics on it, maybe mortality tables for life insurance, maybe auto insurance. You can have pretty good statistics. Uncertainty is everything else. We have a lot we're not even sure. In fact, uncertainty can include risk we're not even aware of. So we've been putting probabilities on risk that, and Doug Hubbard's going to talk about this. How do you do it when it's just so uncertain? So there's some people who think global warming is going to destroy us. What's the probability of that? 3-4%? How do you come up with that probability? And now we even have a higher probability that artificial intelligence is going to destroy us. How do you come up with a probability? I love it when people ask, what's the probability of there's alien life out there? Like, how do you sign a probability to that? When they say, well, how many Earth-like planets are there? Well, you don't know what the probability of life on Earth was because you can't even recreate, so how do you assign probabilities? They say, oh, it's a 90%. What do you mean 90%? Based on what? So you can make up numbers, right? What is the probability AI is going to kill us all? It's somewhere between 0 and 100, right? And where is it between that? Does it make sense to say it's 12.3%? I don't know, but that's uncertainty. We know there's a risk there, and sometimes we don't even know there's risk there. We're not even thinking about it. So risk is the game of chance. It's the statistics. Uncertainty is when we're worried about something, we're not really sure how to handle it. Doug Hubbard is going to help us with that. He's going to say, yeah, it's really, really difficult, but you have some data. And he says you can squeeze a lot out of very little data. That's kind of his point. A sample size of 2 is better than a sample size of 0. And he shows you how statistically that you can actually get some pretty good information out of that. So it's been broadened out so that risk management is actually becoming the group that actually goes out and looks for risk and actually changes how the organization reforms, changes certain things. As I worked in the department, it went from Jerry to like 4 or 5 people that kept adding people. And when, I forget her name, but when she came in, they called her the corporate mom. So she walked around, she was always seeing things, always, she saw these 2 guys, they needed to paint the skywalk. So one guy had the other guy by the ankles over the ledge and he was painting. She turned them in, she got them in so much trouble. It's like those poor guys, and I probably needed a ladder. I remember once, elderly lady got out of a car. We were up right over the main entrance for USA. She got out of the car, and USA had this entrance that was really rocky. And that lady, she tripped and fell. She was probably in her 80s. I remember her name was Todd, and so I got, hey, Todd, did you see that? And I turned around, she's already down there in the lobby. Man, she was like 100-yard dash down there. She was the first person there. She got them to redo that entire entry to USA because of that rock. It must have cost millions of dollars. But that one person fell. She saw it and she was down there so fast. She had a lot of those kind of business looking around what's going on. They had a problem once where people with diabetes were putting their syringes in the trash can. And this was during the AIDS crisis. And the workers were getting stuck with needles. You can imagine people getting stuck with needles. She put up signs in all the bathrooms, please don't do that. You know, this was her job. That was something Jerry wouldn't have cared about. He wouldn't have thought about it. Who cares? Some lady fell in the front, fine, I'll issue the claim. Not that he wouldn't care about her, but he didn't care as far as his job wasn't his problem. Whereas Tom, she saw and says, okay, we got a problem. If someone had a heart attack at work, she wants to know who called it in, who was the first person to show up, how long did it take them to show up, when did the ambulance arrive, how did the ambulance get in where did they come, did we take the body to the person to the right place? She's asking all these questions. Why? Because we need to change procedures. So it's broadening out. Now, why does USA have 1,000 people now? I should ask one, we have some alums that are working in that department. I've spoken to that department before. So I'm not so sure. I spoke to one of them, and he was doing something my department used to do with a half a person, part-timer. And I asked him, how many people in your department? He said 70. I'm going, 70. What are they doing all day long? I couldn't make heads or tails of that he could get 70 people to do that. So then I said, well, did you take all the groups from the subsidiaries and combine them? He says, no, those groups still exist. We're just another group on top of that. It's like, man, that's a lot of money. So I think I'm going to argue they may have gone too far with risk, but they're not here to defend themselves. So I can't say, because I don't really know what they're all doing. So the real goal of all this is risk optimization. What risk optimization is, you take risk where you get paid well, and you avoid or eliminate risk where you're not getting paid well. If you're getting paid more than what that risk is costing you, then you take it. Otherwise, you get rid of it. It's not risk ignorance. It's not, well, if we don't think about it, we don't have to worry about it. And it's not risk minimization. That's what regulators want. That's what credit rating agencies want, is risk minimization. You want to minimize risk because you minimize risk. When United can minimize their risk, just stop flying planes. You never worry about a plane crashing if you don't fly a plane, but that obviously doesn't work for their business model. So you can't minimize risk. You have to take risk, but you have to take the right kind of risk where you're getting compensated. So you want to make sure you're getting paid. I should add the word paid adequately for taking risk. So our risk management process this is pretty textbooky, but we're going to simplify it to define, measure, mitigate. But for risk management, you have to first define, why does the organization exist? What is its core mission? That's why I recommended for your banks, try to find their mission statement. See if the word risk is in there. Why do they exist? What are they trying to do? So like at USA's risk mission statements is pretty decent. It's focused on the military and their families, financial support. So it works really well, but it doesn't have the word risk in there. If it's risk is in there, it's about the risk of their customer, not of the company. I think all of these major banks should have risk as part of their mission statement because they're so massive and they're being supported by taxpayers. I think they have a moral obligation to make sure they're managing risk because we're going to bail them out. But you have to figure out, and this is true for the individual as well. If your goal in life is get married and have 2.5 kids and a house with a fence and a dog and all that kind of stuff, you got to ask, you know, what could disrupt that? So you gotta know what you're trying to accomplish so that you can start assessing the risk. So I think mission statements for organizations are important, not so much that the firm actually follows it, but they're important to see that the firm actually believe it. Does this firm actually have an overarching goal and purpose and mission? I was working with a credit union this year, unfortunately, this last year. Credit unions get this huge tax benefit. Irritates banks. Credit unions are essentially tax-free, and they get this tax benefit because they're supposed to treat the community in a much nicer, friendlier way. And this credit union was horrible. And I kept pointing out to them, you realize you're getting a tax benefit not to do this to us and treat us so badly. And they didn't get it. They didn't want to hear it. I'd love to see their mission statement. I should go look it up. I won't tell you which credit union it is, but if you ask me offline, I'd probably tell you. So is it consistent? And then once you figure out what the organization is all about, then you're going to start doing the risk identification. The risk identification is part of the definition. So this is all part of the definition part. So you can see I have that defined in red. So it starts off with what we call the universal risk. So I mentioned CMRA, Leslie Rawl. Here's their universal risk. There's some strange things in this list. I show this to my executive MBA students and they started laughing because they saw the word haircut. How would haircut be a risk? What do they mean by haircut?
Like you have to pick a discount on your.
Yeah. Exactly. A haircut is, hey, we're going to set aside $1 million to cover the risk of this. And then you discover you should have set aside $3 million. That's haircut risk. You see anything else in there that looks kind of bizarre? We're going to talk about interest rate risk, right? Credit risk. We'll talk about that. Call risk is kind of similar to that. You promise to do something and they call you on it, so you got to pay. It's kind of like having sold a call option and now it's in the money and you got to pay it off. We're going to talk about liquidity risk. We'll talk about accounting risk. We'll talk some about concentration risk under credit risk. Yeah, the iceberg risk is essentially the COVID kind of thing.
Oh.
If something comes out of left field, no one was thinking about it, it just wipes us all out. So, you know, the Titanic, although that wasn't necessarily out of left field. Longevity risk, we talked about that in my my life insurance class. We'll talk about that with annuities. Yeah, the daylight risk is, can y'all guess what that is? So you have a CEO that does something immoral or illegal and it becomes the headline. That's daylight. Well, I'm going to talk about some of those when we talk on operational risk, certainly. We're going to talk ALM mismatch. We don't talk much about commodities. Where is that? Yeah, that's kind of people taking advantage of you because of the assets. We'll probably talk about that when we talk about long-term capital management. But that's our list. That's kind of a bizarre list. USAA had a list of over 100. So, you know, all right, so we're running out of time. So we'll finish up this next class. And then we'll be getting into interest rate risk here pretty quick.